This and more with our next guest, Vinit Sambre, head of equities at DSP Mutual Fund, is joining in. Vinit, great to have you on. Thanks so much for being with us. We were just discussing amongst ourselves because we look at so many views coming in from the sell side, and it's almost like a perfectly balanced market between the bull camp and the bear camp. CLSA, and we were just highlighting this. We spoke to Vikash Jain of CLSA, just earlier. And they're obviously very cautious. They're going with the narrative that earnings are not really picking up and the market's expensive. On the other hand, we just spoke to UBS, Hartmut Issel, their Asia equity strategist, and he says, hey, earnings will pick up. You've got a low base. You'll have double-digit earnings. There's a fiscal boost coming in as well in the form of the income tax cut. So why wouldn't I buy India? He's more optimistic and constructive of the market. Which of these views is more palatable to you?
So clearly, as long-term investors, I think the second view is more palatable. But let me say that I think at the moment, both the views are somewhere, I would say, balanced. And I think it is a time frame with which each of them are sort of looking at the situation at the moment. And clearly, as we have recovered from the market lows, which we had seen in the month of March to now, valuations have seen, it seems to be a bit punchy across the board, not just a few sectors, but across the board. And on top of it, we are entering the first quarter with a slightly moderate kind of an expectation. Demand momentum has still not maybe caught up, to the expectations. And we believe that all the factors, the macro factors which are required, like you mentioned about the taxation, interest rates, and all of those, I think definitely those will have a positive effect on the growth, on the economy. But maybe it takes 2 quarters or 3 quarters down the line, maybe through the festival season, we start seeing some improvement. But I think from my perspective, I would say that the macro factors are now more conducive for growth versus last year. And all of these factors should eventually mean that, and with the low base of last year, maybe this quarter, next quarter, we still have a slightly lower growth. So from that perspective, I would say that the growth outlook should start improving maybe towards the second half, and that's where one should start looking at some directions for the market.
So how has this, Vinit, morning influenced your portfolio decision making, say in the last 1 month? Can you tell us what you all have been doing at DSP Mutual Fund?
Yeah, so see, broadly, I think the portfolios really doesn't change as much really from the very short-term perspective. But broadly, what we are trying to align our portfolio towards is these macro factors which are going to mean that the balance of trade could shift to consumers as a category towards the maybe end of this year. The banking and the lending space could start again becoming good because we have actually reached a stage where the credit growth is lower than the nominal growth of the economy. So that's something which is alarming, and that could sort of start becoming better as we go forward. And incrementally, I think there are some sectors where we believe they have been in the low cycle over the last 2 to 3 years. Including the rural side of the economy, the agri input as a category, the specialty chemicals. All of those are something where we are seeing some bit of recovery trends coming about, while it still remains very volatile globally. But we believe that after having seen a consolidation over the last 2 to 3 years, these segments could also maybe provide a decent opportunity again from the next 2 to 3 years perspective.
Hi, Vinit. Good morning. Good to see you, Vin. What about allocation? There was a time, I think around 4 to 5 months ago, where those small and mid caps that gone through the roof. Then they went through a cooling off period, actually, which would have been a great time to enter. And if I remember correctly, somewhere in the month of March, you were saying that maybe it's a good time actually to allocate to some small caps at this point of time, small and mid caps. Post the recent run up, some stocks have bounced up 30-40% as well. What would your capital allocation strategy be?
No, so I would, Nigel, I'm very biased towards the small and mid cap. Having seen the segment for long now, I believe that generally there are broader opportunities which one is able to play through these categories, and one has to really take a long-term view because we have seen many companies. In fact, let me give an example that 5 years back there was no EMS as a category in India, and look at the market capitalization of the largest company out there. So I would say opportunities are also sort of coming up. One needs to keep a much more diversified view and also a long-term view around these categories. And hence, I would say that having a decent size allocation, if one is thinking of next 7-10 years, towards a small and mid cap is not an issue at all. Short-term movements are very difficult to capture and forecast, and hence I think one should clearly take a longer term view around these.
Vinit, let me quiz you a little more on the consumer call, because that's also becoming, I mean, not a really consensus call in the market, but increasingly people are veering around to the view that at some point consumer stocks have to perk up. Which segment are you relatively more optimistic on? I mean, while discretionary consumption anyways, when we were discussing this actually on the editor's playbook yesterday, and that show will play out soon enough on CNBC Access. But discretionary consumption in stocks like Indian hotels, etc., they've already gone through the roof. But more mass consumption, do you expect that pickup? And how would you play it? Retail, apparel, FMCG, I don't know, coolers, ACs, how would you play it?
No, so I think you're right. And very frankly, it is a bit confusing because very difficult currently to understand the demand trends. While we broadly know that consumption as a category should do well given what's happening. But like you said, I think it is going to be a bit tentative because as we look at different categories, the quarterly numbers or the commentaries are not very clear in terms of how the trends are going to sort of sustain going forward. So maybe it would be a good way to create a basket of categories, a basket of companies within subcategories, maybe a white good as a category, apparels, innerwear, QSR, some of these, and take a broader call that if we broadly are with companies which are sort of leading companies within those spaces and likely to be beneficiary of the macro trends, I think we need to take them as a basket approach, and which is what we have also done as a part of our portfolios. And especially if you look at a small cap fund, I think we have even more broader segments to sort of look at. And from the other perspective, I think we're also thinking that the mass consumption, which you mentioned, I think the low income category definitely, which was hurt a couple of years back. Now, I think we are seeing them also maybe going to participate in this consumption trend. So that's one area. The other, other which is from the macro front, we have a bit of a contra trend, which is the auto ancillary today, where we are seeing the growth for the OEs bit low. But I am generally positive on the auto ancillary front because I think these companies have created very strong franchisee and they are able to capture the global markets and capture even wider areas beyond auto, let's say aerospace, defense, and all of those. So I would imagine that it is also going to be good to have allocation towards those categories because the companies there have created very strong, franchisees for the products which they are into.
Okay, so advisable to take more of a basket approach, basically, because you don't know where the wallet will open and where the money will be spent, whether it's shoes or apparel, like you said. So maybe better to take an overall approach to these things. What else, Vinit? I mean, where else are you optimistic looking at the second half of this year? You mentioned financial services. Again, that's a very wide universe. So there, as we go through this rate cut cycle, I mean, where are you more optimistic? Banks, non-banks, maybe some of the side plays like maybe insurance, capital markets, etc. What do you like here?
So I would say that in the order of, let's say, preference, I would first go for the non-banking financial companies because there the benefit of cost of funds will flow through maybe 2 quarters down the line, and they will see much better growth prospects. Again, the low base should sort of help these segments. Beyond that, I would also say that the life insurance companies, while they have moved up and the valuations particularly are not very attractive, but still, I would imagine that the sector is coming out of a very strong regulatory headwind over the course of last 1.5 year, and maybe and despite those headwinds, I think the sector has performed quite decent in terms of their overall performance. So having a positive view around those as well. And capital markets, actually, it's very cyclical. Maybe next 1 or 2 quarters, if we have more market volatility and some of these names become slightly more palatable in terms of valuations, we are open to look at those as well.
Vinit, thank you very much for joining us this morning. Moving on.